Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Chris, thanks for taking the time out to join me on the podcast, mate.
Thanks, Alan. Thanks for having me on. Looking forward to a chat.
Yeah, we just chatted off air. I think we're both of us are uniquely placed because we get to talk to really good investors all the time. And I thought it'd be a good chance just to hear about you and go through your story and some of the things that are on your mind. As a private investor now, coming off a pretty extensive AFL career. But I'm not sure how familiar you are with the show. I know it's pretty similar to the format of one of your podcasts, but we like to go back and talk about you and kind of the early lessons learned and whether finance or investing was part of your childhood, some of the stories you might have around business, those types of things, and entrepreneurship. So maybe if you could just cast your mind back, the early days, young Chris Judd, if there's anything in particular that you can recall about investing or finance that played a part in your journey.
Well, my first interaction with finance was as a 16-year-old. I got some money from the AIS for part of a football squad I was in. It was $2,500, which was huge money for a 16-year-old.
Sure.
And I had a chat with my dad, and we decided I'd buy some shares with that. Both my parents, the most brilliant parents you could ever ask for, but neither of them are interested in money at all, and not overly financially. They're really smart, but just not interested in money. But my grandpa loved his shares. So my grandpa bought News Corp at 30 cents, I reckon, and held them. I think he bought them when Rupert was still living in Adelaide and held them the whole way through. And he used to love lying on the beach in Noosa in his retirement years. And his main job for the day involved checking the paper and checking the News Corp share price. And so anyway, long story short, me and the old man went down and bought a share magazine to decide what share to buy. And looking back now, you realise just how, stupid a way that is to select what stock to buy. But that's what we did. We were tossing up between Woolworths at $5 and AWA, which was they manufactured some electrical equipment, radios and TVs. And we ended up going to AWA, and it ended up doing well, which, just goes to show you're better off being lucky than being smart sometimes. We managed to sell that, and then eventually I rolled that into buying my first car. So that was a very early introduction into investing as a 16-year-old.
Do you think that had it not been for footy, that you would have become an investor, gone on to study finance or commerce or something like that?
Well, not initially, no. So I was good at English at school. And, I suspect initially my path in terms of uni would have been somewhere in that realms of a field where English is most utilised. So I don't know if it would have been drawn to finance initially. And if I had have gone into a field around English, there's a good chance I wouldn't have had a heap of money to invest either. So maybe I wouldn't have found my way there, but I'm glad I did because I love investing. I love being able to learn about different things. I love the scorecard of whether or not you're right or wrong, but more importantly, particularly in a macro investing framework, you do start to get a clearer picture of how the world works. And I just love that part of it as well.
You mentioned the scorecard there. Obviously, a lot of our listeners will be familiar with your footy career. One of the things that I'm interested to know is, how your, development took place insofar as going from footy and some of the skills and, tricks you may have learned there from a psychological perspective and then applied to investing and learning. Because you mentioned off air that you're sounds like you read a lot. You're an avid reader. You like to read. But I think people that followed your footy career will know that you're also a really good leader, and you applied yourself very professionally to things. And I wonder, did any of that kind of attitude towards sports and that type of thing rub off on you later on when you started to think about business and investing?
I think the psychology around elite sport and investing is actually quite a really nice link. I don't think there's that many lessons in elite sport that are transferable to the real world. There's a little bit around group dynamics and high performance, but that psychology piece is a big one. I think how you respond to mistakes is a big part of that. So, in AFL football is a game of mistakes. Nobody's ever played the perfect game of football. As soon as you step on there, within a couple of minutes, you've made a mistake. And you find the better players are able to stay present in the game and bounce back and still do what they need to do in the next contest and the one after that. And often you see inexperienced players that are still battling with confidence. Once they make a mistake, you can see them go into review mode and they spend the rest of the game reviewing that mistake and what's happened rather than being present and dealing with what they need to do next. So, there's some really obvious crossover with investing. Even the best investors are always making mistakes, and you might see their record in what they've gone up at the end of the year and assume that it's been near on perfect. But if you scratch the surface, there would have been a heap of times they sold too quick. There would have been a heap of placements they knocked back that they should have taken, et cetera, et cetera. But they don't spend the rest of the week or month hanging on to that and stewing over it. They're able to move on and remain clear and calm and analyse what they need to do next. So I think that's an obvious one, but there are lots of obvious ones. I mean, I think, in football, you need to know where your edge is. I was a pretty big midfielder when I first started playing, and I was really quick. And so I would line up against someone, and if they were my size, I knew I was going to be quicker than them. If they were as quick as me, I was usually bigger than them and stronger than them. So I was able to work out really quickly on my opponent where my edge lay and then manipulate the game to suit that edge. And investing's the same. Retail investors will often bemoan that the cards are stacked against them. And in some places they are. Some of the capital raisings that retail investors don't always get access to or don't get much access to is justifiably really disappointing for those retail investors. But there are a lot of other areas that retail investors have an edge over institutional investors. And I think, investors need to be clear what their edge is and how they can use the markets to favour that edge.
It's a very, being self-aware. It's one of those things where, I've known some AFL footballers in my time, and a lot of them, what they had is things like perseverance, but they also had that ability to step outside themselves and critically assess what they were doing wrong or right and work on that and sharpen that edge, so to speak. I now see that in investing, right? Like we see, particularly with retail investors, which you bring up, I see it quite frequently that not enough investors know where their edge might lie.
Yeah.
And maybe they think, it's an analytical edge, but, then there's a supercomputer that can do some rudimentary ratios quicker than you can and trade faster. So I think that's a really important one. How about one thing that's always kind of interested me, Chris, is the transition away from footy, and I guess the decision-making that you had around that to go on and become a private investor, manage your own money. I feel like that's a thing that not many professional sports people would do. They probably wouldn't have the conviction in themselves or even the information and the accumulated information over time to go and back themselves and manage their own money. How did you find that transition away from professional sports to then thinking, I'll take control of my money?
Well, it was a gradual progression. So, I mean, I mentioned the experience as a 16-year-old when I first bought shares. Then I got drafted, had access to some savings and started buying shares from the age of 18 regularly. And I would describe that next decade as making all the sort of mistakes people generally make. I look at the shares I was buying initially now, and I was buying ANZ and BHP, and I don't know how anyone outperforms the market buying those sorts of shares. And then I went to higher risk shares and held on to some crappy things that had run way too long. And moral of the story is, by the time I was 28, I met a guy in Perth who was chairman of a stockbroking firm. Stockbrokers are a mixed bunch. There's some good ones and there's some shoddy ones. And anyway, he's a great broker, super smart. And he really taught me how to invest in microcap stocks. So it's really fortuitous to have that relationship, have someone who treated my money like his own, which is very rare in the broking community. But more so than that, actually taught me how to invest in microcaps and taught me the nuance. Everyone knows the one-line sayings, but there's, let your winners run. Yeah, it makes sense if you've got Amazon, but when you're investing in microcaps in Australia, not many investors have Amazon. So then working out what that really means, how far you do let them run before you actually sell, and all that sort of nuance. So that was fortuitous. Then I played football. Then I stopped playing football quite abruptly, and I took a job as an analyst in a venture capital fund. Right. Giant leap in Melbourne. VC investing is really hard. It's not for me. I put a big premium on liquidity, and I think VC investing, particularly in Australian businesses with a pretty small market, even if things do scale up, it is very expensive. But that was a good experience. I got to meet some new people. And you spoke about the confidence or conviction. I think just actually dealing with professional investors that were sophisticated and getting to meet lots of different people, I think gave me the confidence that I could cut my teeth in this world and make a go of it. And, after spending some time as an analyst and VC investments that personally I didn't see a heap of value in, I was still analysing a lot of listed companies, that some of which I saw a lot of value in. I just thought it made sense to spend more time on the stuff where I wanted to put my own money. And after about 18 months post footy, maybe it was 2 years, I took the plunge to become a full-time private investor. But it was a gradual progression. And looking back, it seems so obvious now that that's what I should have done. But it wasn't the path. It wasn't the most logical path. Post football, I thought I was going to be an entrepreneur because the people I admired most in the business world were entrepreneurs. And I just wouldn't have been suited to it. So there was some good learnings there. I did a personality test about a couple of years post footy that was really quite illustrating. And I had some characteristics, very low in compassion, very, very low in, or very high in disagreeability. And some of those traits, they link to competitiveness, which was useful for sport and is useful for investing. But disagreeability, my wife will say that's challenging being married to someone who's in the bottom 3rd percentile for disagreeableness or agreeableness. But when you're an investor and someone is trying to sell you an opportunity, the last thing you want to be is highly agreeable, because you'll be buying all sorts of crap that you can never sell or profit from. So there's some traits in that personality test which maybe make me a pain in the ass in different areas, but in terms of investing, I think I'm well suited to it. So I feel really lucky that I found my way here. But before, I sunk a lot of capital into a business and was pot committed to becoming an entrepreneur and probably something I wasn't as suited at.
Yeah, well, investing is entrepreneurial anyway, right? Because particularly if you're investing in smaller businesses, because you are taking the risk to invest with founders and CEOs and sometimes businesses that are not yet established. So you do take that risk and you can kind of scratch that itch, I guess. It's interesting that the two things you bring up in the personality test are probably things that aren't necessarily endearing, but we'll take them for investing. And I totally agree with you about being agreeable or disagreeable. One of the things that I try and emphasize is, we don't want a bunch of yes men or women in our team. We want people that have independent thought. Respectful independent thought is probably the most valuable thing you can have in any team. It's not suited to every team, I guess. When you're in an investing team, some people take it personally when they shouldn't, and it just becomes a bit messy. But absolutely in investing, and when you're doing a stock pitch or you've got a proposal, the thing you want is disagreement and respectful disagreement. I'm interested because in this conversation, particularly because there's a lot you have to add, I find, around like the macro thinking. But normally when I do these types of conversations, I have some sort of slide deck, or, a fund manager has philosophy page on their website, which I can kind of glean an insight into how things work. But with you, because you're a private investor, there's not much to go on. So I thought a really good way to talk about it is just from a high level perspective, how you construct your portfolio. And then when we talk about the different, sleeves or elements to that, maybe you can explain, how that suits your philosophy. I know that's a pretty waffly question, but basically let's talk about your portfolio, how you construct it, and then maybe we can pick apart different pieces of that.
Yeah, so I think in terms of portfolio construction, I'm not sure if you've read any of Diego Perilla's stuff. Have you come across him?
Not much, no.
So he's got I think it's just the most eloquent narrative around portfolio construction, which I like. And he equates it to being a soccer team, and you need to know which positions are being filled by which asset classes. So he believes a lot of investors will have just a team full of strikers. And so if you're a micro cap ASX investor, really, it sounds far-fetched, but generally when you're looking to make an investment in a company with a sub 50 million market cap, you're really hoping that goes up 5x or 10x, which we know they're not all going to, but when you write out the check, that's sort of the hope. So essentially, if you're investing in a company hoping for those sorts of returns over 2 or 3 years, that's a striker. That's a really attacking position in the portfolio. Then you've got some cash, which cash isn't a defender. Cash is your interchange player on the sidelines. It can be brought on to buy another striker or another defender, depending on how you see the game going. And then your defenders in the portfolio are gold or bonds. Now, I don't invest in bonds.
Why is that?
I just realized, I came too late to the party to really understand them. And to be honest, up until a couple of years ago, I sort of thought people invested in bonds for the yield. I didn't realize people invest in bonds for capital appreciation until a couple of years ago. And it's a shame, because I would have loved bond investing, because it is a really good expression of macro view. And so often you hear people talk about the stock market not being the economy and complaining about that. Well, the bond market generally has been the economy. But the bond market, you could argue, is starting to die as an asset class. We've got yield curve control in Australia and Japan. The Fed in America have said they're not going to embark on yield curve control, but they want inflation consistently higher than 2%, which felt like that was the first part. There's no use talking about yield curve control when there's no inflation. First, they needed to articulate they want higher inflation. Then, should they get that higher inflation, that's when potentially the yield curve control conversation makes more sense for the Fed to have, because the amount of debt in the system, they're not going to be able to pay high interest rates on that debt. So anyway, I missed the bond market. But I think currency is the next, if we don't get a heap of volatility in the bond market going forward because there's no price discovery, I think we'll get large volatility in the currency markets. I think that's where the volatility will come out. So I've been doing a little bit of currency trading, and I'll probably start to explore that a bit more down the track. But in terms of portfolio construction, I like the Diego Perilla explanation. I've got about 40% of my allocation in gold and silver stocks. I've got some cash there, ready to buy some other things. I've bought a little bit of crypto, which I see as sort of an insurance policy against, the end of the world. And then I've got some shares in predominantly ASX listed smaller cap stocks.
Well, why don't we take them one at a time then? We talked about the right expression of a trade, and you brought in some thoughts there around monetary policy, yields, etc. And by the way, I don't invest in bonds personally either. I think I kind of think the odds are stacked against anyone that considers it. Maybe in some of the hybrids or mixed stuff, like the corporate stuff, you might find some opportunities, but it's pretty hard going elsewhere. But why don't we start? My old man, who was my soccer coach growing up, said that you should always build a sports team from the defense. forward. So why don't we start at the back, and let's talk about you said stocks, like gold stocks and silver stocks. So if I'm not mistaken, you're talking about like ASX listed companies like miners and that type of thing. Do you hold any physical gold?
Not physical, but I've got commodity futures in gold and silver as well.
Yeah, right. So how do you go about thinking about the best expression of that trade being, I'm guessing gold is kind of like that hedge against volatility, capital preservation piece. How do you think about that? Like, is there a particular criteria that you apply to that versus some of the other stuff?
Yeah, so I generally have a really high risk to tolerance. High tolerance to risk.
Mm-hmm.
And I don't have an investment committee I've got to explain my decisions to. We were talking about edge before. I think my ability to tolerate short-term volatility and not have people take money off me like a fund manager would is an edge that I have over institutional investors.
Totally.
So having said that, because I liked the idea around gold so much, I didn't want to be stuck in just a couple of micro cap gold producers or developers or explorers and potentially miss the run because I was too concentrated in a couple of positions. So really, I feel like my gold exposure is almost like a personal ETF. I've got about 15 different gold and silver stocks I'm invested in. I started off with larger, I really started building that around March and April. I had some gold exposure before that, but really went significantly into it around then. And I started with bigger companies and worked my way down, if you like. So I started with installment warrants on some institutional grade ASX companies.
Okay.
The criteria, I really wanted the deposits to be in good jurisdictions. I thought that if the gold price were to go to $3,000 or $5,000, the temptation for a government in a third world country taking that asset off the mining company becomes quite high. So tier one jurisdictions, good management teams, producers is where I started, and I got about 4 or 5 of them, and then I gradually worked my way down the risk curve to some developers and some explorers. And in terms, if I had to just pick one, my bias is probably to gold developers. So particularly if you've got a really long-term view of gold, and I think the gold thematic, I don't think it's a 12 to 18 month thing. I think it's sort of a 5 to 10 year thing, maybe even longer. So to be in a company that's, if you're really bullish long-term on the gold price, to be invested in a company that's quickly digging that gold out of the ground and selling it probably doesn't make as much sense as someone who's not digging it out of the ground. So that's my favorite sort of gold stock to invest in at the minute. Developer, tier one jurisdiction, they've got the gold in the ground. It's a bit like having the physical gold stored for you, but you don't have to pay the storage fees.
Yeah, I was going to say there's kind of 2 angles there, isn't there? There's like I guess with the physical gold, we know that there are some, I guess, shortfalls with that insofar as holding costs, and it actually, doesn't pay you a dividend, that type of thing, but a gold miner would. And so I don't hold any physical gold in my portfolio, Chris, and probably the closest I would go is owning a business that digs gold out of the ground. But how do you think about then, this is kind of an interesting aside, it's just about risk generally. You say you've got a high tolerance for risk. Do you perceive volatility to be the risk for you and your wealth, or do you think that risk is actually in the business itself and permanent capital loss? Like, I'm interested in just some general thoughts around that.
The risk for me is just permanent capital loss. The volatility is uncomfortable, like it is for anyone, but for me, volatility is great for me. Because I don't have a report I've got to type out at the end of the month and send it to investors and wonder if they're going to take their money from me and give it to someone else. So volatility is really challenging for fund managers to deal with, but for a private investor, it's a great opportunity. And provided you've done the work and you know what you've bought, you should be able to deal with that level of discomfort. And it's really that discomfort is what you get paid for as a private investor, being able to put up with it.
For sure. How about then, I guess when it comes to having the gold exposure, let's say as a private investor, and this is just me playing devil's advocate here with the gold position, is what would you feel comfortable having 100% of your money in equities? And I know like the gold, like let's say like gold stocks is equities, but it's a gold exposure. Like let's say industrial companies or something like that, like growth focused equities and companies. Would you be comfortable with that exposure?
If I had 100% exposure in just stocks, full stop?
Yeah, just stocks, full stop.
Yes. Yep. I've done that plenty of times before. I've been largely fully invested before in stocks. Yeah.
So my understanding then with when you say gold exposure, a lot of people use gold exposure, and you know this as well as I do. A lot of people use physical gold or other types of gold linked assets as purely as a hedge against uncertainty and to minimize volatility in a portfolio. But you see it more as like a wealth creation piece alongside the equity, like the other industrials, if you like.
Yeah, absolutely. And I know too that if the market corrects sharply, those gold equities are going to be treated like equities in the short term. And maybe the gold price will too, as fund managers look to liquidate whatever they can to cover margin calls and whatever else. And that's what we saw in March. I mean, everyone in March knew that the response from the Fed was going to be get the printing presses going. And everyone knows that there's an incredibly strong correlation between the size of the Fed's balance sheet and the gold price. But gold price still corrected sharply in that March sell-off, and gold equities got treated like equities. So yeah, look, that's something that can happen in the short term. I mean, one of the reasons I love gold so much is for the optionality. So I think gold's going to do well in a deflationary environment. And I think gold's going to do well in a hyperinflation environment, or even if it's not the Weimar Republic, a really high inflation environment. Where gold's going to really struggle is if we get 2 to 3% inflation and high consistent economic growth. If that occurs, then gold's probably going to struggle. But in terms of that left tail risk of a depression and depreciating asset prices, I think gold does well. In the right tail risk of a really high inflationary environment, gold does even better. So that optionality, which you don't get with silver, silver's only going to do well with that right tail sort of risk. But the optionality that gold provides in this current environment, when you don't need to have an economics degree to work out there's a few challenges going on, and that really nice, positive, consistent growth, it's something I can't see happening.
How about then, let's switch gears. Let's talk about these strikers. It seems like everyone loves to talk about strikers. They always get the highest price in the sporting world. Strikers, I love small cap investing. I love micro caps, all that type of stuff as well. How do you think about that sleeve of your portfolio, and what are some of the factors that go into allowing a potential opportunity into the portfolio?
Yeah, so like you touched on earlier, I like macroeconomic data, or the vast bulk of stuff I read outside of company specific stuff is macroeconomic information. And some of the top down thematics that I like, we've talked about currency debasement and gold already. Aging demographics in the Western world is a really strong thematic that's incredibly easy to predict. Automation and robotics, clean air in China, and clean air in the world, but specifically out of China. And then this move to, I think traditional financials have a lot of headwinds, and things that are being virtualized, or companies responsible for digitizing things or virtualizing them, have a lot of tailwinds. So that doesn't necessarily mean that I think things that fall into that or those categories are good investments. It's still very much price dependent. And if ANZ went to $11 tomorrow, even though it's a financial asset, if it didn't look like it was going to go bankrupt, it may be a great trade. But in terms of longer term and things that I'm comfortable and excited to hold for a long time, something that plays into those top-down thematics are usually the buckets that I'm looking to play in.
I find, like, you don't have to be too specific here, but I guess a really good way to illustrate a process is to just use an example. So is there anything particular recently that has caught your attention, and what I'm particularly interested in is kind of the thought process and the information gathering that went in behind that to progress that idea through your process.
Yeah, so I'll try not to talk stock specific. I think the Australian telco space will see a lot of consolidation. You've seen TPG bought up lots of other businesses and now merged with Vodafone. I think that'll happen again. You're competing against the NBN, which has had its challenges. It's a case of telco and managed services businesses playing to the thematic of virtualizing the world. Zoom is now virtualizing aeroplane travel. Yep. It's virtualizing face-to-face meetings, virtualizing office space. And for all these things to happen, companies have to be connected to the internet. They've got to be protected with cybersecurity offerings. They've got to have cloud infrastructure either with themselves or public cloud. So all these things that now modern businesses need. So I think that's an interesting top-down thematic. So, to be able to find a high-functioning management team that plays into that space that could be part of a roll-up or could be acquired eventually is an interesting play. That's a for instance, if you like, and those examples I've got examples of whether it's a nickel cobalt company that's going to play in the clean air thematic, or uranium. I quite like. I don't know if it's a super long-term hold, but I think you get a nice trade out of uranium with the supply-demand imbalances that appear to be occurring. That's sort of a bit of an overview, if you like.
Yeah, I guess so. What I'm reading into this is that the big, as a top-down investor, which by the way we don't get many of on the show, at least not in the private investor landscape. It's more bottom-up approach is who I speak to. So what I'm getting is that a lot of this top-down reading and research that you do, this information gathering, is more so around assessing the opportunity set. And then you can use that to progress kind of through to the next level of your filter, if you like, and assess each position case by case. How do you think then about, let's go to another part of your portfolio, which is this currency angle and the trade you're thinking about there. What goes into your thinking then? Is it? I know you talk a lot about modern monetary theory, about geopolitics, interest rates, central bank action, those types of things. Maybe we can talk about currencies and what goes into analysing that position in your portfolio.
Yeah, so I try and keep things pretty simple because I'm not that clever. So I view gold as a currency, not as a commodity, for starters. Gold has an 84% correlation with the direction of the Fed's balance sheet, which we've spoken about. It's also got a really strong inverse correlation to real interest rates. So when real interest rates are low or negative, that's really good for gold. And we also know that, the debts that have been incurred around the world, they can really only be eradicated by default. So the US government could default on their debts, or they can inflate away their debts. And the last time, and Luke Groman speaks a lot about this, the last time the fiscal situation was so dire in the States, where they were in so much debt, was 1946. And for the next 35 years, real interest rates were negative for most of that period, the vast majority of the next 35 years. So, and I also think people can be a little bit lazy. So we didn't get inflation post the GFC. Everyone knows that. We didn't get inflation in CPI, so everyone's assuming that won't happen again. But we did get inflation in asset prices. We did get, arguably because so many central banks around the world are printing, currency to currency isn't the best way to analyse which currencies are going up and which currencies are going down. But when gold that increased in production at 1.5% a year since 1970 versus US dollar that's gone, when money supply has increased by about 10% over the same period, that's a pretty good long-term bet for mine. I don't think money supply is going to reduce rapidly in the next few years. If anything, I think it's going to ramp up even more. You know, the US has $8.5 trillion worth of treasuries that mature by the end of 2021. You know, I'm sure some other countries are going to refinance some of that or buy the bonds to refinance some of that. But a lot of that's going to be left to the Fed. And so those sorts of things I think are really bullish for gold in a long-term sense. And I think, you know, the US dollar sort of has to devalue against the gold price because we see how much damage it does to the world economy if it's too strong. And I think the US throughout this COVID experience has seen how vulnerable they are if manufacturing isn't brought back onshore. You know, have 90% of your antibiotics made in China leaves them really vulnerable at a time when, I mean, globalization isn't ending, but I think it's going to be reduced and we are going to see more localization. So that globalization thematic has been great for really rich people in first world countries, and it's been great for people in third world countries. But for working class people and poor people in first world countries, it's just been a disaster. And I think you can see by the civil unrest and the difference between capital and labour being as big as it's ever been in the history of the world. If that doesn't right itself, we're going to have, you know, you're not going to be buying gold, you're going to be buying pitchforks. So I think that's sort of where the world's at.
Yeah. It's I know you do a lot of reading around this, and one of the things that gets talked about a lot is this idea of MMT.
Yeah.
And this kind of, I think it's like an old way, because it's not necessarily recent. Like the guys that kind of fostered this started thinking about it in the early 2000s, late 90s, and on an internet discussion forum. And it's now gaining traction because of the situation, particularly the US is in with such a high level of debt. So I thought maybe because you are definitely the expert on this rather than me, I was hoping maybe you can explain the concept of MMT for people that maybe haven't heard of it before, and maybe how that plays into your thinking in that, I guess, that thesis that you just gave to us.
Well, my, I guess, understanding of MMT, which is by no means expert, is that basically, it's basically what people think, what a lot of people think is already happening for that to actually happen. So a lot of people just think, you know, the US government sell bonds, the Fed buys those bonds and gives the money to the US government. And it's sort of happening in an indirect way. But I think MMT is a way of formalizing that process whereby saying, you know, QE at the minute is meant to be temporary. We had quantitative tightening in 2018, I believe it was. So, and the Fed is an independent body, theoretically. It's not actually joined with the US Treasury. So MMT is basically saying deficits don't matter. We'll print money and buy bonds direct from the US Treasury. They'll then go and spend the money. And if inflation, and that only becomes an issue when inflation comes and inflation's higher than we want it to be. But the tweak point in MMT is to not then adjust interest rates to deal with that inflation. It's to judge taxation. So that's basically my understanding of MMT. Basically print money, commit to fiscal stimulus. You know, if you're talking about the Democrats, you'll potentially even have something like a universal basic income. You can print MMTers believe you can print as much money as you want and it doesn't really matter unless you get serious inflation. And then the way to reduce inflation is through taxation. So what's really happening now in QE is the money gets stuck in QE, if you like. And, you know, we touched on inflation before, and, you know, really smart people like a Lacey Hunt, who's just a brilliant economist, believes that if the Fed goes direct and they're all of a sudden allowed to spend and not just loan money, then that will be hyperinflationary, he believes. Right now, the Federal Reserve Act, they're only allowed to loan money, right? And so MMT is almost changing those rules. You Yeah, which would effectively lead to just a huge increase in fiscal spending. And I think what we didn't get last time post GFC is we didn't get that increase in fiscal spending. If you recall, we had the Tea Party, Republican Tea Party, tried to squash a lot of the fiscal initiatives that Obama's government tried to implement. So we got a bit of fiscal spending early on. Then we almost got fiscal austerity in the US and particularly in Europe too. I think that's what will be different this time, is that we will have this loose monetary environment and we will have a really high fiscal spending environment. And Jerome Powell's already said that he can't create inflation by himself. He needs fiscal assistance, and that government should be spending more in a fiscal sense. You've seen France just commit to an increase in fiscal spending and saying they're not going to worry about the restrictions the EU put in place. We've had some fiscal stimulus in Australia in terms of government handouts since the virus hit. So I think everywhere you're looking around the world, fiscal stimulus is coming or seems to be coming. And I think that's what will be different to the way this crisis has been handled versus the GFC crisis, which ended up being a deflationary or largely deflationary outcome.
So I had to brush up on this when we spoke last week. I had to go away and read a fair bit and watch a few interviews on this, Chris. And some of the things that I took away, and you mentioned Jerome Powell there, is some of the proponents for MMT would question whether monetary policy or interest rates works at all, and would say that during the GFC or in the lead up to the GFC, as interest rates went higher, that benefited the wealthy people, but the people who don't have money in the bank, for example, actually do not benefit from that and end up paying more on their debts. And so you get that rising, inequality in a way. So it almost has the opposite effect. They don't know which one's the gas pedal, which one's the brake pedal with monetary policy. Like, do we know for sure what impact it has? And then the other one was that you could use this kind of universal income to balance employment and inflation that way. And I guess if I could tuck one third one on here, is that you only get inflation when you have, repurchase of the same asset. So a repurchase of the same asset. So for example, if you buy something, if the government buys something today, it sells it, then buys it back at a higher rate. If you're still printing more money on top of that, then you're going to get more inflation in the system. Those are just my general, high level observations when it comes to that. If you're sitting back thinking, I've got this gold position, would this MMT effectively, are you concerned that would, if we bring this in, effectively neutralize that position for you and end between the right and the left tail and put it somewhere in the middle where it's not really useful for your portfolio?
Yes, I think that's a weird possibility. So you've got huge deflationary forces at play. You've got aging demographics in the Western world. You've got technology, which has been a huge force for deflation. Globalization has been a huge force for deflation, but I don't think that's going to be the case going forward. And that localization process may be net inflationary. But then you've got a lot of inflationary forces that we've spoken about as well. Fiscal stimulus being the big one, currency debasement gives you the potential for high inflation. Is there a possibility that those two things could almost cancel each other out? Potentially, but one of the things, the way I look at it is, if we get deflation, central banks are just going to print that much money. I agree that just straight QE where interest rates go to zero and the money sits in the bank account is deflationary, but it's still good for the gold price. You're still going to have money supply going up through the roof, the size of the Fed's balance sheet increasing significantly. So I think that's still going to be good for the gold price. The thing about the right tail risk is at the start, it will feel really good. At the start, we'll get some inflation. And I think there will be this feeling that maybe we've just discovered the secret sauce. We can just print as much money and spend as much fiscally, and we can have full employment. And I think because when that starts, it will feel good, the authorities will do too much of it. And or if full employment is good, well, why can't everyone get a 10% pay rise? Wouldn't that be better? And so it goes on until you do get really high rates of inflation. I think if you look at, people's ability to have self-control or deal with any sort of discomfort is just so low throughout the world at the minute. I think that sugar rush when things, if they were to balance each other out evenly, I think the inflation will feel good at the start, and that's what will lead to the problems. So it's possible, but it's not what I think is the most likely outcome.
It's interesting. I should circle back to this and say MMT, with the debt to GDP ratio, which is what so many people focus on, it kind of throws that aside and says, well, we'll always be able to service the interest costs. The interest costs necessarily aren't productive for our society, but we'll always be able to service them because we can print money and make that happen. And this, typically, when we think about MMT, it only applies to developed countries that have their locally denominated debt and have their own currency under their control. So there are a few things there that people should be aware of. One of the things that I wanted to talk to you about is, I guess, your time horizon when it comes to trades. You mentioned earlier that potentially, short term, you have an ability to change your opinion on something very short term because you are a private investor after all. But when you look out to say things like gold positions or even company specific positions in your own portfolio, have you thought that maybe that should be measured in years, months? I'm just trying to get a general sense on how long you look to invest and how long you actually invest.
So it's so different for each company and each specific investment. So, I might take a placement in a company and hope to be flipping it out within a week just because it's a small position, it's at a good discount, and it's well bid for. And then there'll be other companies that I've done a lot of work on. I've met management, I'm comfortable with their long-term plans, and, I would like to hold them for forever, or 5 years or 10 years. But it's so specific to each company and each setup. But generally, the more money you're putting in, the longer you want to hold it because it's going to be harder to get out of it. So I don't sort of invest in a company all in the first time I invest in it. It'll usually a process of, you might get to know management, like the business, do some work on it, invest a sum of money. 6 months later, the management have hit all the milestones they've been trying to hit. You might invest some more money, or they might do a capital raising to buy another business, and so it goes on. The general, I guess, theme from my investing is if I'm going to have a winner, I want it to be a really big winner. And sometimes that'll mean that you're investing in a company and it might not do much for a few years, but in that time, you might get more and more comfortable with management. The long-term play appears to be playing out how you expected it to. And then, you might decide that there's a time 18 months down the track or 3 years to double up on that investment, or, to put the chips all in, so to speak. So it's not sort of fixed, but I'm generally trying to cut losers quickly, as everyone should be. But I'm also much more likely to average up than average down. And if I'm going to have a big winner, obviously I want it to be material. That's sort of how I view things.
Do you write down your thesis, or do you have like notes that you take on each company and you put it somewhere to kind of keep yourself accountable to your past self? And I find it so important to write something down. You mentioned English before as something that you're really good at. I feel like since I've been writing down my reasons for buying something, which has been quite a few years now, the leaps in my investing and in a positive way have been incredible. Versus what I was doing in the past, there was almost no track record. You don't even need like a number or percentage, but just a track record against yourself in a journal or something like that. Do you write down your positions pre-investment?
I'm meticulous in keeping records of what I'm invested in, and so I'm really clear on what the performance is. I don't write down the investment thesis, but I will know and I'll map out before I invest in, particularly if it's a reasonable size position, milestones that I can potentially see happening in the next 2 years that could lead to a re-rate if they get achieved. And then I'm really, really disciplined, particularly now, if I can't see why that could get re-rated higher in the next 12 months, well, I'm just a seller. There's always a new opportunity. And if I miss out on that one and it goes on to double or even more, we'll sort of so be it. Because there is always another opportunity, and that opportunity cost. And even when you go back, or when I go back and analyse the companies I've sold, the vast majority of them, I'm happy that I've sold when I have. So I think property investing is all about the buying, and the good property investors buy really well. I think share investing is all about the selling. It's really hard to sell well as a share investor, but I think that's where the main skill lies.
Yeah, I know I can put my hand up. I'm probably the worst person to take advice from when it comes to selling. It's almost, I almost never get any of it right. So I don't get the timing right, and I often sell companies before they've actually done what I thought they would do in the first place. But then again, I've only sold 3 positions in the last 2 or 3 years, so I guess I can control myself and my weaknesses there. As we kind of come to the back of it, mate, I know you've got a podcast that's just killing it. You do videos. It's great. You've got kind of these 2 channels, which I think our audience would be really interested in listening to. Did you just want to give a shout out to them?
Yeah, thanks for that. I've got Judd Invest is the overall channel. I've got the Masters of the Market show, which is this is your lifestyle show of an investor or fund manager, where they walk through their life lessons and the things they've picked up along their journey in the investing world. And then I've got a show called Talk Your Book, which is a different investor's highest conviction investment idea. They come on and talk through usually a stock specific idea, why they like it, and what the potential catalyst could be to see it re-rate.
I think the whole thing you've put together, mate, is really good. And I've listened to a few. For example, Michael Goldberg was on the show recently. He made the connection for us, and I watched a couple of your interviews with him where he's been on the Talk Your Book segment, and it was really good. I think I listened to all of them that Michael was on, and that's how I got onto him. So one thing that I always ask my guests before I let them leave is just some of the advice that you'd have for a younger you. If you could go back and tell yourself, maybe even before you were 16, maybe when you bought that first share, perhaps, one thing about investing, what would it be?
Don't assume somebody is smarter than you because they use a lot of acronyms.
I like it, mate. Chris, thanks for taking the time out to join me on the show, mate.
Beautiful. Thanks, Owen. Really appreciate it.